Have you ever felt like the market is against you, no matter what you do? One day you're up, the next day you're crushed, and the only thing that seems to be changing faster than the charts is your mood. If that sounds familiar, you're not alone. Most traders lose, not because they don't know strategies, but because they don't know how to control themselves. This video is not about complicated indicators or magic formulas. It's about something far more powerful: your mind. Because the truth is, trading is 80% psychology and only 20% strategy. If your emotions run the show, your account won't last long. But if you learn to master your reactions, control your impulses, and think clearly under pressure, you'll have an edge that most traders never develop. Inside these pages, you'll find practical tools, real-life examples, and step-by-step guidance to help you stay calm, focused, and consistent. No boring theory, no unrealistic promises, just lessons you can apply immediately to trade smarter, not harder. And if you're here reading this, I know you're serious about taking your trading to the next level. So stick around, dive into the chapters, and let's work together on building the strongest weapon a trader can ever have: emotional control. Oh, and one more thing. Don't forget to hit that subscribe button. That way, you won't miss the upcoming videos and more powerful lessons designed to make you a better, calmer, and more profitable trader. Chapter 1. Price speaks louder than indicators. Have you ever opened your chart and felt like it looked more like a Christmas tree than a trading screen? Red and green candles covered with moving averages, MACD waves, RSI squiggles, Bollinger bands, Fibonacci retracements, all stacked on top of each other. You zoom in, you zoom out, but instead of clarity, you feel lost. Should you buy? Should you sell? Or should you just shut the laptop and walk away? This is the reality for most traders. They believe the answer lies in adding more tools, more confirmation, more indicators. But ironically, the more they add, the worse their trading gets. Confusion replaces confidence. Noise replaces signal. And slowly, account balances get smaller. The truth is, every single indicator, whether it's RSI, MACD, or fancy custom script you bought online, comes from one thing: price. Indicators don't have special powers. They don't predict the future. They are simply mathematical formulas applied to past prices. That's it. And since they use past data, they lag. They show you what already happened, not what's happening right now. Think about this for a second. Imagine you're driving a car. Price is like the windshield. You see the road ahead in real time. Indicators are like the rear-view mirror. They show you where you've already been. Both can be useful, but which one will stop you from crashing? Which one will help you take the right turn in the moment? Of course, the windshield. That's what price action is: the clear view. Now, let's talk about why so many traders still cling to indicators. It's because indicators feel safe. They give a false sense of certainty. A green arrow means buy. A red arrow means sell. It feels like someone is holding your hand, but in reality, those arrows often come late. By the time the buy signal appears, the move is already halfway done. By the time the sell signal flashes, the price has already dropped. This is why so many beginners complain that indicators don't work. Price, on the other hand, is always on time. It's raw. It's honest. Every tick, every candle tells you the collective decision of millions of traders across the world. When price breaks a key level, it means real money just shifted in or out. When price forms a strong rejection, it tells you buyers or sellers just defended their ground. This is information you can use immediately, not after the fact. Let me give you an example. Imagine a stock trading at $100. It's been bouncing between $98 and $102 for days. You load your chart with RSI, and it shows overbought when the price hits $100. You hesitate, thinking it must fall, but suddenly the stock explodes to 110, and RSI stays overbought the entire way up. If you had trusted RSI, you would have missed the move, or worse, gone short and taken a loss. Now, if you had just looked at the price, you would have seen it was consolidating tightly and building energy near resistance. Once that resistance broke at $102, that was your real signal. Price told the truth. RSI lied. This is not to say indicators are useless. They can provide context. They can help beginners stay organized. But relying on them is like learning to ride a bike with training wheels and never taking them off. You'll never experience true balance until you take them away. The goal of this book is to give you that balance, to help you trust the market itself, not a tool sitting on top of it. So, how do you listen to price? The first step is clearing your chart. Strip it down to nothing but candlesticks. At first, this will feel uncomfortable. Naked, you'll crave the comfort of your moving average lines. But stick with it. When you look at nothing but price, your brain starts to adapt. You begin to see patterns you never noticed before. You see how the market breathes, how it trends, how it ranges, how it fakes out. You'll notice that price moves in waves. It doesn't go straight up or down. It pushes, pulls, corrects, and continues. When it's making higher highs and higher lows, that's a trend. When it's stuck bouncing between levels, that's a range. When it breaks a level with strong momentum, that's a breakout. These are not theories. These are the building blocks of price action that traders have used for decades, long before modern indicators were even invented. Here's another important mental shift. Stop trading what you hope will happen. Most traders look at a chart and think, I hope it goes up, or I hope it drops. That's dangerous. Hope is not a strategy. When you focus on price, you trade what you see. If the price is breaking out of a range with strength, you trade the breakout. If the price is rejecting a level again and again, you trade the rejection. You're reacting to the market, not predicting it. Let me share a personal story. Early in my career, I was addicted to indicators. I had MACD, RSI, stochastic, moving averages. My charts looked like a rainbow explosion. I'd wait for all the signals to align. By the time they did, the move was already over. I was always late. My losses piled up. One day, frustrated, I cleared all the indicators off my screen. I told myself, I'm going to trade with nothing but price. At first, I felt lost, but slowly I started to notice key levels. I noticed how price reacts differently during high-volume times. I saw how the market telegraphs its next move through structure. Within months, my trading turned around. The market is a conversation. Every candle is a sentence. Every trend is a story. Indicators are like subtitles. They can help, but sometimes they're delayed or even mistranslated. If you really want to understand, you need to listen directly to the voice of the market. That voice is price. As you move deeper into this book, you'll see how simple trading becomes once you accept this. You don't need 10 tools screaming at you. You just need your eyes, a clean chart, and the discipline to read what's in front of you. The more you strip away, the more clarity you'll find. Remember, trading is not about predicting the future. It's about reacting to what's happening now. And nothing shows you now better than price. Chapter 2. The Art of Reading Price Action. Trading without indicators might sound intimidating at first, but once you strip away the noise, something amazing happens. You start to see the market for what it really is. The market is not random. Chaos. It has a rhythm, a structure, a story. And that story is told through price action. Price action is simply the movement of price on a chart over time. Every tick, every candle, every breakout is a piece of information. Put together, they form patterns that repeat over and over again. Once you learn to read those patterns, it's like learning to read a new language, the language of the market. And the best part? This language has been the same for decades, across all markets: stocks, forex, futures, crypto. Human psychology drives price, and psychology hasn't changed in centuries. Let's start with the basics. Candlesticks. At first glance, candlestick charts look complicated, like strange hieroglyphics. But each candle is just a simple story. The body shows where price opened and closed during that time period. The wicks show the extremes, the high and low. When you look at one candle, you're seeing a battle between buyers and sellers in that time frame. For example, imagine a strong bullish candle with a small wick at the bottom and no wick at the top. That candle is saying buyers took control early, pushed the price higher, and held strong all the way to the close. That's conviction. Now imagine a candle with a long wick on top, but a small body at the bottom. That candle is saying buyers tried to push it higher, but sellers stepped in and slammed it back down. That's rejection. Suddenly, these little bars aren't just shapes, they're voices in the market's conversation. But the real power comes not from one candle, but from sequences of candles. Just like you can't understand a story from a single word, you need to read groups of candles to understand market context. A string of higher highs and higher closes tells you the market is trending upward. A series of indecisive candles near a major level tells you the market is hesitating, waiting for a catalyst. Support and resistance are the next critical pieces of the puzzle. Think of support as the floor and resistance as the ceiling. Price bounces between them because traders all over the world see those levels and act on them. If a stock keeps bouncing off $100 every time it drops there, that's support. If it struggles to break above $110, that's resistance. When price finally breaks through one of those levels with conviction, it often leads to big moves. Why? Because traders pile in, either chasing the breakout or stopping out of their old positions. Now here's where it gets even more interesting: supply and demand zones. These are areas on the chart where price has previously made strong moves. If price rallied sharply from $95 to $105, that $95 area is a demand zone. Buyers were aggressive there. If price dropped hard from $110 to $100, that $110 area is a supply zone. Sellers dominated there. These zones often act like magnets when price returns, because traders remember them. Institutions especially place large orders in those areas. Learning to identify the supply and demand gives you an edge, because you're aligning yourself with the big players. Trends are another vital part of reading price action. A trend is simply the market moving consistently in one direction, up or down. In an uptrend, you'll see higher highs and higher lows. In a downtrend, you'll see lower highs and lower lows. Spotting this doesn't require any moving averages. Just look at the chart. Is price stair-stepping up or down? The tricky part comes when trends shift. A break of structure, like price failing to make a new high, and instead forming a lower high, can signal a reversal is coming. If you can spot these early, you're ahead of most traders. Volume adds another layer of confirmation. Even if you're not using fancy volume indicators, you can see the raw volume bars on your chart. High volume on a breakout means the move is strong. Lots of traders are participating. Low volume on a breakout is suspicious. It might be a fakeout. For example, if price breaks above resistance at $110, but volume is weak, chances are it won't last. If it breaks above with huge volume, that's real strength. Volume is the lie detector test for price action. The best way to train your eye is through step-by-step chart breakdowns. Take any chart, clear it of indicators, and ask yourself, what story is this chart telling me? Where are the key levels? Is it trending or ranging? Are there signs of exhaustion or continuation? Do this daily, even on charts you don't plan to trade. Over time, your brain starts to recognize patterns automatically. When I first started, I used to print charts and mark them up with a pen, circling support, resistance, trends, and big candles. It felt old school, but it trained my eyes faster than anything else. Today, I don't need to think twice. When I open a chart, I can instantly see the story. That's the kind of skill you're building by reading price action. And here's the key. This skill works across all time frames. Whether you're day trading on a 5-minute chart or swing trading on a daily chart, the principles are the same. Price action doesn't change. It just zooms in and out. A bullish, engulfing candle on the 5-minute chart means the same thing as on the daily. Buyers took control. A support level on the 1-hour chart works just like one on the weekly. Once you master this language, you can trade anything, anywhere. But let's be honest, it takes practice. You won't become fluent in price action overnight. At first, you'll doubt yourself. You'll misread signals. You'll see patterns that aren't really there. That's normal. The market is the ultimate teacher, and experience is the tuition. The more charts you study, the sharper you'll get. Eventually, reading price will feel like second nature, like reading a book in your native language. The beauty of price action trading's simplicity. You don't need a cluttered screen. You don't need to wait for 5 indicators to agree. You just need to observe price, react to what it's showing you, and manage your risk. Simplicity leads to clarity, and clarity leads to confidence. And in trading, confidence is everything. Chapter 3. Simplicity is the ultimate strategy. One of the hardest lessons traders learn is that more is not always better. In fact, in trading, more usually means worse. More indicators, more lines on the chart, more signals to process. It all adds up to confusion. And confusion in the market is deadly. Think about the best traders in history. Did Jesse Livermore use RSI or MACD? Did Paul Tudor Jones wait for a 14-period stochastic crossover? Of course not. They relied on simplicity, price, levels, trends, and risk management. Because at the end of the day, trading is not about who has the fanciest tools. It's about who can make the cleanest, clearest decisions under pressure. Simplicity is the ultimate strategy because the market itself is simple. Price can only do 3 things: go up, go down, or stay the same. That's it. Everything else, indicators, oscillators, signals, is just noise layered on top of that simple truth. Once you accept this, your trading world becomes clearer. You stop chasing every new tool and start mastering the only thing that matters: price itself. A clean, no-indicator trading system starts with one thing: your chart. Strip it down. Remove every indicator. Keep nothing but candlesticks and maybe volume. At first, it feels uncomfortable, almost naked. But over time, you'll realize how freeing it is. Instead of waiting for signals, you're reading price directly. You're responding to what's happening right now, not what some lagging formula is telling you happened 5 candles ago. But simplicity doesn't mean randomness. You need rules. Every system, no matter how simple, needs structure. The beauty of a no-indicator system is that your rules are based on what the market is actually doing. For example, you might have a rule to only trade breakouts from consolidation zones, or a rule to buy when price makes a higher low at support. or a rule to short when a strong rejection candle forms at resistance. These are simple, clear, logical rules anyone can see. Risk management is where simplicity really shines. Most traders blow their accounts not because they can't find good entries, but because they can't manage risk. They risk too much on one trade. They move their stop loss when the trade goes against them. They over-leverage, thinking one big win will solve everything. Professionals do the opposite. They treat risk like oxygen. They never put themselves in a position where one trade can kill them. A simple rule for risk is this: never risk more than 1 or 2% of your account on a single trade. That means if you have $10,000, your maximum loss per trade should be $100, $200. That way, even if you lose 10 trades in a row, you're still alive. You still have capital to fight another day. Survival is the name of the game. If you survive long enough, you'll eventually hit the trades that pay for everything. Here's the truth most people don't want to hear. Losing is part of trading. You can't avoid it. Even the best traders in the world lose 40–50% of the time. What makes them winners is not avoiding losses, but managing them. They keep losses small and let winners run. That's it. If you can lose small and win big, you don't need to be right all the time. You just need to be disciplined. Now let's talk about entries and exits, the part everyone loves. Most beginners obsess over finding the perfect entry. They want a magic signal that guarantees the trade will work. That doesn't exist. What you need is not perfection, but consistency. You need to follow the same rules every time so you can measure and improve your results. For example, imagine your rule is this: you only enter trades when price breaks above resistance with strong momentum and volume. That's clear. That's objective. Every time you see it, you take the trade. Sometimes it will work beautifully. Sometimes it will fail. But over 100 trades, you can measure your win rate, your risk-to-reward ratio, and your edge. That's how real traders operate. Not guessing, but following rules they can test and refine. Exits are just as important. Too many traders take profits too early or hold losers too long. Simplicity here means defining your exit rules before you enter. Maybe you decide you'll always risk $100 to try and make $300. That's a 1.3 risk-to-reward ratio. If your stop is $1 away, your target is $3 away, you don't move it because of fear or greed. You let the math play out. Over time, that math is what makes you profitable. Patience is the hardest part of simple trading. Most traders want to be in the market all the time. They feel like if they're not trading, they're missing out. But the truth is, the money is made by waiting. Waiting for A-plus setups. Waiting for price to come to your level. Waiting for the market to give you a gift. If you trade every single movement, you'll bleed slowly. If you wait for the best setups, you'll win big and often. Let me share a story. Early in my career, I traded every single day, multiple times a day. I felt like I had to always be doing something. My charts were full of indicators, and I'd jump into trades at the first sign of movement. I lost money fast. One day, an older trader told me, "You don't get paid for activity. You get paid for patience." That stuck with me. I started waiting. I stopped chasing every candle. I only traded when my exact setup appeared. My win rate went up, my stress went down, and my account finally started to grow. Case studies prove this point again and again. There was a study on traders who used simple moving averages versus traders who used price action at key levels. The price action traders consistently outperformed. Why? Because simplicity removed hesitation. They weren't waiting for 5 different signals. They had one clear trigger. Another example comes from Forex traders who used nothing but support and resistance zones. Their performance was stronger than those using complex algorithmic indicators. The reason is simple. The market respects levels, not formulas. The biggest advantage of simplicity is psychological. Trading is stressful. The more complicated your system, the more decisions you have to make under pressure. And the more decisions you face, the more likely you are to make mistakes. A simple system reduces decision-making. You see the setup, you act. No second guessing. No paralysis by analysis. Just execution. Think about it like fitness. You don't need 100 different exercises and a complicated routine to get in shape. You need a few basic movements done consistently. Push, pull, squat, run. That's it. Trading works the same way. You don't need 20 strategies. You need 1 or 2 simple, repeatable setups you can master and apply with discipline. Another key benefit of simplicity is adaptability. Complex systems break when the market changes. Simple systems bend but don't break. Support and resistance will always matter. Price action will always matter. Risk management will always matter. These principles don't go out of style. They've worked for decades and will keep working decades from now. Of course, keeping things simple doesn't mean it's easy. In fact, it's harder for most traders because it requires trust. You have to trust that your simple rules will work over time. You have to resist the temptation to add more indicators, more filters, more confirmation. But if you can resist that temptation, you'll discover a freedom most traders never find. So what does a simple, no-indicator trading system actually look like? Here's an example. You focus on one market, say the S&P 500. You mark majors, support and resistance levels on the daily chart. You drop down to the 1-hour chart to find setups. You enter when price rejects a level with a strong candlestick pattern. You risk 1% of your account, targeting 3%. That's it. No moving averages. No MACD, no noise, just price, levels, and discipline. Over time, this approach can outperform the most complex system. Because here's the truth. Complexity does not equal profitability. In fact, the opposite is often true. The traders who make consistent money year after year are the ones with the simplest systems, the clearest rules, and the strongest discipline. They're not chasing every new strategy on YouTube. They're quietly, patiently following their simple plan, while others chase shiny objects. If you want to succeed in trading, embrace simplicity. Let go of the idea that you need more tools, more signals, more complexity. You don't. You need less. You need clarity. You need patience. You need discipline. Simplicity is not just a strategy. It's the ultimate strategy.